Catching up isn't about saving more. It's about sequencing correctly. Most people never figure that out. If you are 50 or older, that mistake costs you over $40,000 in unused tax-advantaged contribution room every single year. Last time, we covered the first half of the priority stack, steps 1 through 4, the $1,000 cash buffer, the employer match, high-interest debt, the full emergency fund. If you haven't watched episode 1 yet, go there first. This video picks up at step 5 and runs to the end. Here is where most late starters stall. They hit step 2, the employer match, and they feel like they've handled it. 5% in, match captured, and move on. And 5 years later, 10 years later, they are still sitting at step 2. No Roth IRA, no HSA invested, 401k stuck at the default contribution. Steps 5 through 8 are sitting there, untouched. Here's the cost of that. If you fund a Roth IRA at maximum contributions from age 45 to 65 at 7% average annual return, you end up with over $300,000. All of it tax-free. Not taxed going in, not taxed coming out. Every dollar you withdraw at 65 is yours. No deductions, no adjustments. If you never open that account because you stopped at step 2, that money does not exist. At 65, you cannot go back and fund those years. The window closes permanently. That is what stalling costs. Not a vague future inconvenience, a real, specific, 6-figure number. Steps 5 through 8 are the gap closing engine. Let's build it. Step 5, max your Roth IRA. The 2026 contribution limit is $7,500. Source, IRS, Notice 2025-67, verified before this recording. If you are 50 or older, you get an additional $1,100. Your ceiling is $8,600 per year. That catch-up increase just happened for the first time since 2006. The IRS indexed it to inflation. Use every dollar of it. Income limits apply. Here is the exact threshold. Single filers can contribute the full amount if your modified adjusted gross income is below $153,000. Married filing jointly, the full contribution holds up to $242,000. Most of you watching this can contribute directly, but if your income is above those thresholds, the backdoor Roth conversion is legal and worth doing. Here is the mechanic. You make a non-deductible contribution to a traditional IRA. Then you convert it to a Roth. There is no income limit on conversions, only on direct contributions. Do not skip step 5 because of income. There is a legal path around the limit. Why does this matter more at your age than it did at 25? Because at 25, you have decades to manage your tax exposure in retirement. At 47, you need every tool that protects what you actually keep. Tax-free withdrawals are not a minor benefit at this stage. They are a structural advantage. Step 6, max your HSA if you qualify. To use an HSA, you must be enrolled in a high-deductible health plan. If you are, this account has a benefit structure that does not exist anywhere else in the U.S. tax code. Triple tax advantage means 3 things. 1, your contributions go in pre-tax. 2, the money grows tax-free. 3, withdrawals for qualified medical expenses come out tax-free. No other account does all 3. Not your 401k, not your Roth, not your brokerage. The 2026 contribution limit, $4,400 for individual coverage, $8,750 for family coverage. If you are 55 or older, add another $1,000 per eligible individual. Here is where most people make the mistake. They use the HSA like a spending account, money in on Monday, copay out on Thursday, balance near zero by December. That is the wrong frame entirely. The right move. If you can cover medical expenses out of pocket right now, do it. Let the HSA balance sit, let it invest, let it compound. After age 65, an HSA functions exactly like a traditional IRA for any expense at all. Not just medical, any expense. You are building a second retirement account that most people treat as a debit card. The difference in outcome between those two behaviors, compounded over 15 years, is not small. Step 7. Max your 401k beyond the match. Pay attention to the word beyond. Step 2 was the employer match. That decision is behind you. This step is different. This is pushing your own contribution to the IRS annual maximum. The 2026 standard limit is $24,500. That is your employee contribution. Your employer's match is on top of that. If you are 50 through 59 or 64 or older, catch-up contributions are available. Add $8,000 more per year. Your total annual ceiling, $32,500. If you're turning 60, 61, 62, or 63 this year, your number is different. Secure 2.0 created a super catch-up provision specifically for this 4-year window. Your catch-up limit is $11,250. Your annual total ceiling, $35,750. That provision was not created by accident. Congress built it because they recognize that the 60 to 63 window is one of the last high-earning, high-contribution years before retirement. If it applies to you, use every dollar, one flag for higher earners. Starting in 2026, if you earned $150,000 or more in wages in 2025, your catch-up contributions to a 401k must go into the Roth side of the plan. Pre-tax is not an option for the catch-up portion above that threshold. Make sure your plan has a Roth 401k option and that your contribution election reflects this. If you are unsure, call your plan administrator before your next contribution. Step 8, taxable brokerage and optimization. This is the last step, not the starting point. I want to say that clearly. A lot of people start here, they open a brokerage account, put money in, and skip everything above it. That is the wrong order. Once your foundation is in place, remaining capital goes into low-cost index funds. Asset location matters here. Tax-inefficient assets belong in your tax-advantaged accounts, bonds and REITs. Those go in the 401k, not the brokerage. Equities can sit in taxable, and while you are here, check your overall allocation. Most default target date funds assume a 30-year timeline. Your timeline is 10 to 20 years. A 60-40 allocation at 47 with a retirement target of 65 is likely too conservative. You need more growth exposure than those defaults provide. This is not a prescription. It is a flag to verify your actual numbers with a fee-only advisor who does not earn commissions. The sequence only pays off if you complete it. Steps 1 through 4 buy you stability. They stop the bleeding. Steps 5 through 8 build the compounding engine. Most people stop at step 2 and call it a plan. That is not a plan. That is a starting position. There are over $40,000 in tax-advantaged contribution room available to most people in their 50s. Most of it goes unused because they never built past the employer match. Before you move money through these steps, you need to know where you actually stand, not where you think you stand, where the math says you stand. The Late Starter Wealth Audit is 10 questions across 6 wealth categories: retirement, cash flow, debt, tax, income, emergency, then you get your tier, on track, building, behind, or critical, and a prioritized action list telling you exactly which step to address first. It's only $17 and takes 10 minutes. Link is in the description. Score your position before you move money. Next video, we run the actual math. A real scenario, a specific gap, a specific age, and whether the numbers actually close it in time. That video is in the next card.